Well, one of the big questions is whether tax cuts will increase overall economic growth and by how much. There's new analysis tonight from a leading group of economists, and Steve Liesman has that part of the story.
Business economists estimating the impact of the tax cut on overall growth and are finding positive but modest effects. And there's a significant debate as to how long-lasting those effects will be. Economists at the National Association for Business Economics on average see a 0.2% kicker to GDP for 2018. At Goldman Sachs, they see it at 0.3% for 2018 and 19, but they see it as temporary. John Riding at RDQ also sees a 0.3% impact, but he thinks it's going to be more permanent. Supporters of the tax cut plan think it will increase capital spending that could boost worker productivity, boost worker wages and jobs. They also like the idea that it could cause trillions of repatriated foreign cash to come back from overseas, and it will reduce inefficiencies in the economy. Those who don't support the plan are worried about increased deficits, see the Federal Reserve having to tighten policy more than it otherwise would. They're concerned it would raise inequality as many of the benefits flow to the wealthiest Americans, and they're skeptical on the job and wage effects. John Riding at RDQ writes, quote, "The drop in the corporate tax rate would make the U.S. look competitive relative to overseas." Riding sees a permanent upward shift to potential growth. But Goldman says after growth increases in 2018 and 2019, quote, "We note that the effect in 2020 and beyond looks minimal and could actually be slightly negative." One of the big concerns has been about the $1 to $1.5 trillion in deficits the bill could generate and whether it means higher interest rates. Rates have been on the rise as the chance for the bill's passage has increased, and the market now sees multiple rate hikes next year as more likely from the Federal Reserve. For Nightly Business Report, I'm Steve Liesman.